Something just snapped in the silver market, and if you blinked, you missed it. We're talking about a collapse from roughly $121 down to the low 70s, and then, almost immediately, a violent reversal. Western spot silver ripped back toward $90 an ounce, up nearly 12% in a single day on February 3rd. Meanwhile, Shanghai barely flinched, holding closer to 95 to 100 the entire time. Both the futures tape and the physical markets just confirmed the same thing at once. This wasn't random. This was mechanical. And if you're holding silver right now, or if you're watching this market trying to figure out what just happened, stay with me, because I'm going to show you exactly what triggered this move, why it matters right now, and how you can spot this kind of pattern before the crowd even realizes it started. Your job isn't to panic. Your job is to understand the mechanics. So let's break this down. Before I explain what caused this, let me teach you something most people don't really understand about markets like silver. Price isn't just about supply and demand. It's also about leverage, plumbing, and who's being forced to act at the worst possible moment. Think of the market like a crowded theater. Everything's calm until someone yells fire, and then it's not the strongest or smartest people who move first. It's whoever's closest to the aisle and most panicked. In markets, that fire is margin pressure. When leverage gets too high, price stops reflecting reality and starts reflecting who's being forced to sell right now, regardless of value. That distinction matters more than almost anything you'll ever learn. Here's what I mean. Let's say you bought silver at $90 with borrowed money. You put up $10,000 of your own cash, but you're controlling $50,000 worth of silver because you're using 5-to-1 leverage. That's normal in futures markets. Now silver drops to 85. Suddenly your account is down 5,000. Your broker calls and says you need to add more money or they're closing your position. You don't have more money, so you sell. You're not selling because you think silver's going to zero. You're selling because you have no choice. That's forced liquidation. And when enough people are in that same situation at the same time, price doesn't move based on fundamentals anymore. It moves based on who's got a margin call and who doesn't. So what does that tell us? It tells us that in leveraged markets, price can disconnect from reality temporarily. Physical buyers might still want silver. Industrial users might still need it. But if enough paper traders are getting squeezed, price falls anyway. And that's exactly what we just saw. Now, if this is making sense so far, drop a comment below and let me know you're following along. I want to know you're getting this, because what comes next builds on this foundation. Now here's what's actually happening. Let me break down the sequence, because this is where the real lesson is. Silver didn't collapse because physical buyers disappeared. They didn't. Coins, bars, and industrial demand didn't suddenly evaporate. What triggered the drop from 121 to around 71 was a leverage purge. CME margin requirements jumped, volatility spiked, and suddenly, over-leveraged long positions couldn't meet collateral calls. So they sold. And when they sold, price dropped. And when price dropped, more stops were hit. That's the cascade. Forced selling feeding more forced selling. Let me walk you through the mechanics step by step. Silver's been on a tear. It went from the mid-20s in early 2023 to over 120 in late 2024, early 2025. That's a massive run. And whenever you get a move like that, leverage builds up. Traders pile in with borrowed money trying to catch the wave. Speculators, hedge funds, even retail traders using margin. Everyone's long. Everyone's expecting higher prices. Then something changes. In this case, the CME, that's the Chicago Mercantile Exchange where silver futures trade, they raised margin requirements. Why? Because volatility was getting extreme. When silver's moving 5, 10, 15% in a day, the exchange has to protect itself. So they say, okay, you want to hold this position? You need to put up more cash. For traders who are already stretched thin, that's a problem. They can't meet the new requirements, so their positions get liquidated automatically. The broker doesn't ask, they just sell. And when thousands of contracts get dumped into the market at once, price doesn't slowly decline. It crashes. We saw silver go from 121 down to the 70s in a matter of days. That's not a fundamental shift. That's a technical unwind. But here's the part most people are missing, and this is the part that should make you nervous if you're not paying attention. The rebound didn't start because of bullish headlines. It started because the mechanical pressure turned off. Shanghai prices never broke the way Western paper prices did. They stayed elevated, closer to 95 to 100, the entire time. Let me explain why that matters. Shanghai is a physical market. When you trade silver in Shanghai, you're dealing with actual metal, not just paper contracts. The price there reflects what people are willing to pay for real, deliverable silver. Western markets, especially the COMEX in New York, they're futures markets. Most contracts never result in physical delivery. They're just bets on price direction. So when margin pressure hits the COMEX, price can tank because traders are liquidating paper positions. But in Shanghai, if people still want physical silver, price stays firm. And that's exactly what happened. While Western spot silver was hitting the low 70s, Shanghai was still trading in the mid to high 90s. So once margin stress eased, Western prices didn't lead anymore. They chased. That's not sentiment. That's structure. And when structure shifts, momentum traders, macro funds, and even cautious allocators start revising targets fast. You're already hearing near-term talk of a 150 overshoot if momentum feeds on itself. And longer-term projections? Some people are pushing 250, even 500 by 2026 if liquidity expands and physical demand stays tight. Now, I'm not saying those numbers are guaranteed. I'm saying that's what the market's starting to price in. That's what people are talking about. And when the conversation shifts like that, it tells you something about market psychology. Here's the thing. This playbook isn't new. We've seen it before. And if you understand the pattern, you can recognize it when it happens again. Let me take you back to 2011. Silver topped around $49 an ounce in April of that year. It had been on an absolute tear, doubling in less than 6 months. Then the CME stepped in. They raised margin requirements 5 times in 8 days. 5 times in 8 days. What happened next? Silver crashed. It went from 49 down to 26 in 2 weeks. That's nearly a 50% drop. Traders were getting blown out left and right, forced liquidation everywhere. But here's what happened after that. Once the forced selling ended, once everyone who had to sell was already out, price stabilized. And then it rebounded. Not all the way back to 49 immediately, but it didn't keep falling either. It found a floor, consolidated, and eventually started climbing again. The point is, the drop wasn't because silver fundamentally changed. It was because leverage got too high and the system had to flush it out. Same pattern we're seeing today. Let's go to another example. March of 2020. Remember that? Everything crashed. Stocks, bonds, gold, silver, everything. Silver went from $18 down to $12 in a matter of days. People were saying the silver trade was dead. Physical demand didn't matter anymore. Everything was selling off. But what happened next? The selling stopped. Physical premiums exploded. Dealers couldn't keep coins and bars in stock. And price didn't just recover, it surged. Silver went from $12 in March to nearly $30 by August. It more than doubled in 5 months. Why? Because once the forced selling ran its course, once everyone who had to liquidate was already out, there was no one left who had to sell. Pressure faded. Shorts started covering. Paper prices had to reconnect with physical reality. That's when you get a snapback, not a grind. When you zoom out and look at those moments side by side, the pattern is clear. Sharp leverage, driven collapse. Temporary dislocation from physical markets, then a fast, aggressive realignment. The larger story is that these events don't end trends. They reset them. They clear out the weak hands, the over-leveraged speculators, and they create a foundation for the next leg higher. If you understand that, you're not panicking when you see a 50% drop. You're watching for signs that the forced selling is done and the rebound is starting. That's the advantage you get when you know the pattern. Now, let me be skeptical for a moment, because you should be. Could this just be a dead cat bounce? Absolutely. Could macro conditions tighten further and pressure metals again? Of course. Could we see another leg down if the Fed pivots hawkish or if global liquidity tightens? Yes. And here's the thing about manipulation narratives. They're tempting, but they're not actionable. You can't trade villains. You can spend all day arguing about whether central banks are suppressing silver, whether JP Morgan's got a secret stash, whether this whole thing is rigged. Maybe it is, maybe it isn't, but it doesn't actually matter for your trading decisions. What you can trade is structure, levels, and behavior. Focus on what you can control. Watch price response, not opinions. Watch whether physical and paper stay aligned, not whether someone on social media says the fix is in. Because even if there is manipulation, even if there are bad actors, the mechanics still work the same way. Leverage still unwinds. Forced selling still creates opportunities. Physical demand still puts a floor under price. You don't need to know who's pulling the strings. You just need to know how the machine works. That's the difference between someone who's frustrated and angry at the market and someone who's actually making informed decisions. So here's what I want you to think about. There are probably 3 types of people watching this right now. The first type is already in silver and feels whiplash. You bought in at 90, maybe even higher. You watched it go to 121. You felt like a genius. Then you watched it crash to 70 and you felt sick. Now it's back at 90 and you don't know what to do. If that's you, I get it. Here's my advice. Your job isn't to predict the top or bottom. It's to manage risk and watch whether this rebound holds above 85 to 90. If it does, if we see consolidation in that range and then a push higher, that's a sign the structure is rebuilding. If it breaks back below 80, especially if it loses 75, that's a different story. You need to have a plan for both scenarios. Don't let hope or fear make your decisions for you. The second type is skeptical and thinks this is all noise. You think silver's a relic, or you think this whole move was speculative froth and it's going back to 30. That's fair. You might be right. If that's you, wait for confirmation. Watch whether 95 to 100 gets reclaimed in the West, matching Shanghai. Let the market prove itself to you. Don't fight the trend just because you don't believe in the story. Price is the ultimate arbiter. If silver holds these levels and starts pushing higher again, you can reassess. If it rolls over, you are right to stay out. Either way, you're making a decision based on what's happening, not what you think should happen. The third type is newer and wondering how to even approach something this volatile. You've never traded silver before. Maybe you've never traded anything before. You're watching this unfold, and you're trying to figure out what it all means. If that's you, here's what I want you to take away. Zoom out. Learn how forced liquidation works, because you'll see it again. In equities, in crypto, in bonds. Different asset, same movie. Every time leverage builds up, every time volatility spikes, you get these sharp, violent moves that don't reflect fundamentals. And every time, the people who understand the mechanics have an edge over the people who are just reacting emotionally. You don't have to trade silver to learn from this. You just have to understand the pattern. So here's what I want you to answer in the comments. Which type are you? Are you already in and managing a position? Are you skeptical and watching from the sidelines? Or are you new and trying to learn? Let me know, because I want to tailor future content to where you actually are, not where I assume you are. Here's where I stand. I'm not euphoric, and I'm not dismissive. I'm observant. Let me tell you what I'm personally watching. First, I'm watching whether 85 to 90 holds as a launch zone. If silver can consolidate in that range and hold it on a pullback, that would tell me the forced sellers are out and buyers are stepping in. That's constructive. Second, I'm watching whether 95 to 100 gets reclaimed decisively, signaling parity with physical markets. If Western paper prices can get back to where Shanghai's been trading this whole time, that tells me the dislocation is over and the two markets are aligning again. That's when you see momentum build. Third, I'm monitoring 70 to 75 as the line in the sand. If we break back below that, if we lose those levels on volume, that would tell me the rebound was just a short covering rally, and the trend is still down. Based on my analysis, this move wasn't emotional. It was mechanical. The fundamentals didn't break, they reasserted themselves. Physical demand is still there. Industrial use cases are still growing. Central banks are still buying gold and silver. Supply constraints are still real. None of that changed just because leveraged traders got blown out. What changed was the price, temporarily, because of technical factors. And once those technical factors ran their course, price started moving back toward where fundamentals suggest it should be. If history rhymes and silver holds these levels, the move that follows could be significant. We've seen it before in 2011 and 2020. Sharp drop, violent rebound, and then a sustained leg higher. I'm not saying that's guaranteed. I'm saying that's the pattern we've seen historically when you get this kind of setup. And if you understand that pattern, you're not surprised when it plays out again. You're prepared. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Look at the charts yourself. Check the historical data. Don't take my word for it. But if you made it this far, you're the kind of person who thinks critically and wants to understand how markets actually work, not just follow the herd. That mentality will serve you well, not just in silver, but in every market you ever touch. If you found this useful, share it with someone who's trying to make sense of what just happened. Hit that subscribe button if you want more breakdowns like this. And stay ahead of the noise by thinking for yourself. This isn't about being bullish or bearish. It's about understanding the mechanics so you can make informed decisions, regardless of what the market does next. Stay sharp out there. Think critically. Verify the data, and make your own decisions.